Hey, it is legally, medicating is not illegal anymore.
It depends on where you at.
Exactly. So, I mean,
Oh,
hey,
City
Oh,
Kenny.
Brian,
what up?
you make me host, bro. It won't even let me screen share.
Well,
Hmm.
really?
Yeah.
Oh, you're not co-host. Did you change accounts? That's why.
Oh, my bad, bro.
I made Wallace your other account co-host.
Ah, yeah. So I'm on the one I use for school.
Yeah. All right, you should be good now. And I think I already started recording.
All right, cool. Good looking to you.
So I'm glad I'm glad I procrastinated.
Man, me and you both. I was about to call you.
All right, guys. I'll see you guys in 10 or 15 minutes.
Dope.
All right.
All right, let me get all
I'll
of
be
this
late.
away. Boom, boom, boom. Market cycle, market movement. Guys, the introduction to the Elliott Wave Principle. So, what we're going to cover tonight, guys, I'm going to try to help you guys train your eyes to look for major market structure. All right. The reason why we want to first look for major market structure is that's where price typically does, its major swing points or reversal points, right? So if we know that, the market's at some type of major market structure, we can begin to read price action or how the candles react to that particular support or resistance. Now, when I refer to market structure, all I'm referring to, guys, is like support and resistance with history. So, and what I mean by that is it has to be like a retest to the same area. And again, I'm gonna show you all this stuff on the charts, right? So let's hop into it. Now, market movement, guys, right? So it's always the bulls versus the bears. We have to identify a retracement versus an actual trend reversal, right? We're going to cover some basic wave patterns. I'm going to go over different wave characteristics for you guys, and we're going to dive into the guidelines for the application of your Elliott wave, right? Now, there's three essential guidelines or three essential rules for applying Elliott wave that we'll also go over. My man, I appreciate you, bro. I was starving. Now, we're going to be able to identify and label the waves. So understand, guys, that this is a complex concept, and we'll just touch on the very basics to help jumpstart your path. And remember this thing, guys: cycles within cycles, right? There's always a cycle running on every different time frame, and I believe that's why some people get confused as to which way the market is going when they're shifting through all of the different time frames. So with the three screens, I help basically keep you guys from doing that, basically, right? Going through all of the different time frames. Now you can if you want to, but understand that you guys really need to focus on three different types of time frames. Now, brief history on Elliott Wave. Just a moment, let me pull this up real quick. All right, Elliott Wave history. Here's some background on it. Hey, did I get a fry? Get a straw? I got a straw. No straw? Oh, good looking. All right. Sorry about that, guys. So, Elliott Wave history, guys. Here's the background on it. So, the Elliott Wave principle is based on Ralph Nelson Elliott's conviction that social or crowd behavior tends to trend and reverse in identifiable patterns or cycles. He identified a number of patterns of movement or waves that reoccurred in combination with larger and or smaller versions of the same patterns. That single line alone is why I say, keep in mind cycles within cycles, right? So those who are well versed in the intricacies of these patterns can gauge where the market's recent movements fit into them, and then predict where the market will move to complete the cycle. Elliott Wave cycle, guys, runs on every time frame. And because of that, that can cause a lot of confusion because one time frame might be bullish, the other one might be bearish, right? So again, cycles within cycles. So starting out, guys, we focus on the daily, the 4-hour, and the 1-hour time frames to identify Elliott Wave, starting at the beginning of a swing low or a swing high. And this becomes between whichever time frame, those 3 time frames that you find that on, that becomes your structure chart, right? So knowing the different characteristics of the individual waves will help you identify which wave the market is currently trading within. And again, I'm gonna stress this, guys, all night. Cycles within cycles. So the 3 essential rules, there are 3 essential rules for applying Elliott Wave. And then there's a couple of various guidelines to help apply and identify different components of Elliott Wave. We're going to cover that stuff tonight. So the basics, right? Now, a single cycle of Elliott Wave consists of 8 waves, all right? That's the 5 waves that are numbered, 1 through 5, and then the 3 corrective waves that are lettered A, B, C. These waves are labeled using letters and numbers. The impulse or the motive waves are labeled with the numbers. That's the trend, right? That's the trend, the major trend that we see. The retracements or corrective waves are labeled using the letters. That's the ABC portion that I always tell you guys about, that I always look for. We always enter on the retracements, right? Each of the individual waves have their own characteristics that will help identify them. And then this cycle, guys, runs both bearish and bullish. So in an uptrend, you'll find it, and in a downtrend. Now, where's my little mouse at? So wave 1, wave 2, wave 3, wave 4, wave 5. Each of those waves, guys, have different characteristics that will help identify them, along with waves A, B, and C. All right, so 3 cardinal rules. Let me make sure that's the right spot. Yes, that is. Okay, so the 3 cardinal rules to Elliott Wave, right? Understand that these rules are just merely guidelines that were proven to have a high success rate when followed through, even though it's not 100%. So first of all, understand, even though, guys, these have a high success rate, it's not 100%, okay? But we're not here to be 100%. Nobody's ever going to be 100%. So the 3 rules are in bold right here. So the first one is wave 4 cannot enter the price territory of wave 1. Now, understand that wave 4 is a retracement wave, okay? If the retracement wave closes, if retracement wave 4 closes lower than retracement wave 2, then you're looking at something else on the larger scale than the retracement. All right. If wave 2, the second rule, wave 2 can't retrace more than 100% of wave 1, according to the Market Technicians Association. If it does, then wave 2 might not have been a corrective wave as originally thought, and could actually be moving in the direction of a motive wave to a larger degree. And that's the same as the first rule as well. Wave 3, which often represents the strongest part of the market cycle, it can't be the shortest by price when compared to wave 1 or wave 5. Now again, understand, guys, that this isn't 100%. And sometimes wave 3 isn't the longest. Sometimes it's wave 5. Sometimes it's wave 1. But as long as you know the characteristics of a wave 3, you'll be able to identify which one is which. So the picture to the right, we've got in the blue, highlighted in the blue, it says wave 2 never retraces more than 100% of wave 1. Now, it can pin below the low of wave 1, and it can actually do a candle or two close below wave 1, just barely. But if it's not a clean break of structure, expect that to be just that, a reversal or a double bottom, like a W, okay? On the green wave 3 cannot be the shortest wave. Now again, wave 3 can be, how do I say this? So wave 3 is typically an extended wave, meaning you'll see a clear 5-wave move of Elliott within that single push up itself. Now, sometimes it will be in wave 5, sometimes it's in wave 1. More times than not, it's in wave 3 though. Now, finally, in the pink, it says wave 4 does not have candles that close in the price territory of wave 1. So I want to stop right there real quick because I want to show you guys what it is we're actually looking for, and that's what we're actually looking for. So at the pink on the graph to the right, guys, where you see the number 1 at the high, that number 1 that set that high, that's a swing point. That would be where a ceiling or a resistance is, okay? Now, since that is I guess, identified as a resistance and it created that wave 2 or that retracement from it, wave 3 then broke through that, all right? So since wave 3 broke through that, if wave 4 indeed break down into the price territory of wave 1, comes back up, tests the bottom of it again, and fails to break back above it, you're looking at something of a larger degree, some type of retracement to a larger degree, okay? And that's honestly a setup that we look for. So wave 3 broke through the structure of wave 1. Wave 4 would be the retest of the ABC, and we're looking to get in at the C point met with the structure at wave 1. And that's all we're doing, guys, and I'm going to show you that tonight. So what are the different wave characteristics, all right? Every wave, impulse, and the corrective have their own individual characteristics that help to identify them. So when applied together with different guidelines, we will cover later, identifying the waves becomes just a little bit easier, guys. One of the keys to interpreting wave counts is to determine what degree the wave in question represents. So, wave 1. Wave 1 is an impulse or a motive wave, right? It's either at the top or the bottom of a trend. Wave 1 is the hardest wave, I would say, to identify because there's not really a clear trend change until you see like the low or the high of wave 1 tested, right? And it fails, like a double top or a double bottom type of ordeal, right? So that's what makes it kind of hard to identify because you expect that to just be, a retracement at first. Wave 1 is also less emotional as the prior trend is still in control. So wave 1s tend to be real slow movement and kind of choppy. In wave 2 is a retracement or a corrective wave. So understand that wave 2 cannot retrace more than 100% of wave 1, even though it can extend the low created by wave 1. I should say the low or the high. So in this image to the right, we've got wave 2 that creates a higher low than the low of the wave 1, right? The start of wave 1. This is actually the first time that we can begin to apply the guideline of alternation, and I'll cover this later on, guys. And traders usually continue to sell, so movements are usually steep and sharp. Now, wave 2 usually corrects more or most of wave 1. So typically, you'll see like a deep 786 retracement or 886 retracement with wave 2. Now, here's the thing with wave 2, guys, in comparison to wave 1. Wave 1 typically looks like it's just a retracement itself from the prior trend. And then when wave 2 hits, since that is like a steep type of retracement and it's usually sharp, it looks like it continues the prior trend. All right. And once that fails to break that lower high of the prior trend, guys, then you will create either the double top or the double bottom or the higher high or the higher low or the lower high, basically, with wave 2. Again, wave 3 is the impulse wave or a motive wave. It usually has the largest change from swing low to swing high in terms of price, okay? And powerful moves are made in this wave, okay? This wave is emotional. It's most often the longest, steepest, and strongest of the waves. So this wave actually gives you guys the greatest profit potential in most cases. The extended wave does. Now, notice again that wave 3 breaks the high that wave 1 creates. So in order to validate that break of structure as now a support, price has to come down and test that high that wave 1 created, basically, right? If price gets below wave 2, the low of wave 2, then you're looking at a trend reversal. That's a nugget. Wave 4, guys. Wave 4 is another corrective wave. Now, since we've seen wave 2, we can have some type of expectation of wave 4 by applying the guideline of alternation. And before I go on, I know there's some
Since you're, can I interrupt you for 1 second? What was that nugget? I was writing, but I missed the last sentence.
Yes, ma'am. So the previous nugget was if I was speaking in terms of wave 3. So
Right.
since wave 3 broke the high of wave 1, which the high of wave 1 was at first a resistance, right?
Uh-huh.
Its price is above that now, it has to validate it as a support. So if price validates it as a support and you see a lot of rejection, like it's going to bounce back up, then you're good to go.
Yeah, but isn't that just creating a zone between 1 and 4 with the rejection of the, like if you draw a line from that 1 to the 4, you just the higher high to the higher low, and just creating a zone, so you wait for the rejection.
Correct. But if price from wave 4 gets below that structure that you drew that line at and closes below the low of wave 2, you're looking at a trend reversal.
Right. Yeah. And I'll just get out. I didn't even think about that trade. But all right.
Yep.
But before you said if wave 3 breaks the high of wave 1, that's also a continuation,
Correct.
right? That just right.
Oh,
So that
yeah.
that nullifies the Elliott wave.
Not necessarily, because we enter on the retracement waves, right?
Oh, true that. Yes. Sorry.
Let's see here. Any other questions? Oh, shoot. Hold on.
I have a question real quick. Are you talking, one thing I have a really hard time with is the wicks or the bottle of the body of the candle. When you're looking at this, are you going for wicks or bodies?
So when it comes to breaks of structure, I'm looking for bodies to be closing above them or below them, above that structure or below the structure. It can wick all it wants to. That's fine. But as long as the bodies themselves aren't closing above or below the structure that you're looking at, then you're looking at something else. And I'll cover a break of structure versus, just wicking and stuff tonight too on the charts. Any other questions? All right, let's get going. Now, wave 4, again, is another corrective wave. And this is where we can apply the guideline of alternation with wave 2. So just to touch on that real quick, earlier, giving the description of wave 2, I said wave 2 is more times than not a steep and deep type of retracement against wave 1. If that's the case, then wave 4, guys, would look more like a sideways consolidation and not as deep or not as steep as wave 2. And it also goes vice versa. If wave 2 is the kind of shallow type of retracement or consolidation, then expect wave 4 to be deeper. And that's the guideline of alternation. And I'll touch on that later down the road too. Wave 4 is where early traders take profit, others enter long and witness some whipsaws, okay? Wave 4 usually moves sideways in a consolidation or kind of like a pennant or a flag. Wave 5. This is the final advance, guys, towards either the high or low before a major retracement happens. We're looking for testing and failing of the high or low, depending on what trend you're in. We're looking for a change in momentum. And if we are using the RSI and MACD, we can also look for some type of divergence, right? After this wave, the market will enter into an ABC corrective phase. Understand, guys, the ABC corrective phase is generic, okay? There are other complex retracements to the market. Now, 2 asterisks right there at the number 1. This is one impulse wave on a higher time frame, guys. This is one cycle within the cycle. So from 1 to 5, that is one wave on a higher time frame. If we were looking at wave 1 on a lower time, let's say we're looking at the hour time frame, right? And we wanted to look at wave 1 on the 15-minute time frame, we'll see wave 1 through 5 and probably some ABC retracements. And that's what the cycles within cycles does. And I'm gonna show you guys a little cheat sheet tonight that I usually save for the last class, but I'll show it to you guys tonight. Ooh, look at that typo.
That.
Let's see. Corrective
You gonna
wave.
have-
Go ahead.
I was about to say, you gonna have that cheat sheet available for us?
Yeah. I'll post it. Elliott wave, corrective waves or retracements, right? So now we're off of the momentum or the impulse waves or the trends, right? Now we're looking at the retracements. So notice that they're labeled differently, right? They're labeled with letters. Correction to the market happens after a trend or an impulse wave. So correction takes place after impulse waves 1, 3, and 5. So 2 and 4, guys, are retracements or corrective waves. Excuse me. The guideline of alternation can also be applied within the corrective waves, which is an excellent thing. It's labeled ABC, but also can be extended to adding letters like D, E, G, F, and so forth, W, X, Y, and blase, blase. It just depends on the complexity of the retracement, basically. Correctional wave A. So the market will still be in an overall bullish or bearish trend, meaning that this is only a correction to the market. And that's how we look to buy the dips on the bull market and look to sell on the uprising in the bearish market. Okay, so in the image I've been showing you guys has been a bull trend. So since this is, wave A is going down, we're looking to buy on the downtrend, right? Because we're expecting that to just still be a retracement. Now, if wave A, guys, travels in 5 waves, meaning it does its own Elliott impulse wave in 5 cycles, right? Or 5 waves, cycles within cycles, it will be a deep type of zigzag, the whole ABC correction. If wave A travels in 3 waves, it's going to be a flat or a triangle structure. Those 2 lines right there are big because I'm gonna show you some images of different type of corrections later, right? Wave A sets the tone for wave B in the corrective phase. So what that means is depending on which of the first 2, if wave A is in 5 cycles or if it's in 3 cycles, wave B, guys, is going to react in a certain way. Wave B is the trap wave of the corrective phase. Traders become euphoric and anxious about continuing the prior trend. This is a good place for a counter trend trade, guys, with wave C coming, because wave C usually gives away some pips. Corrective wave C. Wave C, guys, is a killer wave. It kills all profit, basically, right? It wipes out all positions from the impulse impulse trend. And it is often an extended wave, meaning it often has its own 5 cycles that it runs through, or 5 waves that it'll go through. Once it is over, it's time to get back in the market for the major trend. Now, these are different correction patterns. So depending on the complexity of the retracement, it will form different patterns and extend wave counts beyond the normal ABC. We'll cover this, guys, in probably the advanced portion. We'll get deeper into like the complexity of the retracements, but understand that, like, you know, the different types of technical patterns, like the wedges, like the falling wedge, the bullish triangle, the bullish rectangle, the bullish pennant, the rising wedge, and things of the sort. Those are different retracement waves that are complex. So they'll use letters from A, B, C, D, E, F. Sometimes we'll use W, X, Y, Z, and things of the sort. That's all stuff that I get deeper into in the advanced course. I cover Elliott Wave all in the advanced course only. So what are the guidelines for the application, or how do you apply this stuff, right? So first of all, you have to understand, guys, that a guideline is not a hard and fast rule that can't be broken. It's a tendency. It's something that happens so often that it can almost qualify as a rule, except for the times it doesn't work as expected, okay? Now, the guidelines are useful for applying Elliott Wave analysis and have shown their validity over time. But understand, guys, they are not rules, and they may not work out every time. More times than not, they will. But again, nothing in Forex world is 100%. So the first guideline is the guideline of equality, or market symmetry, right? I always say, or I always talk about, you know, the market likes to move in 1-to-1 ratio or equal movements or market symmetry. And this is what I talk about. It likes to be even or balanced. The market likes to stay balanced. So the guideline of equality says that 2 of the motive subwaves in a 5-wave sequence will tend toward equality, and is generally true of non-extended waves. So what that means, guys, is earlier I said wave 3 is usually the longest wave, right? Or the extended wave of the 5 impulses. So what that says is wave 5 will approximately equal wave 1 in price, is what the guideline of equality says. So let's say wave 1 was the extended wave. Then that means you can expect wave 3 and wave 5 to be some type of equality. If wave 5 is the extended wave, you should have seen or noticed that wave 1 and wave 3 were trending towards equality as far as their price. How far did they move in price, right? That's the guideline, guys, of equality. The guideline of alternation for a trend or an impulse, right? I touched on this earlier. The guideline of alternation within an impulse says that the forms for wave 2 and 4 will alternate. If wave 2 is a sharp style of correction, then wave 4 is going to be more of a sideways or a consolidation. If wave 2 is sideways or a consolidation, then wave 4 is going to be the sharp or the deeper type of retracement. Now, this is useful for anticipating the end of a wave 4 correction within a suspected impulse. So that way you can understand, you know, wave 5 is coming up, it's going to enter a nice retrace. If wave A is a flat type correction, wave B may be a, oh, I'm sorry, I skipped something. If wave 2, the guideline of alternation within a correction says that the forms of wave A and wave B will alternate within a 3-wave correction. I also said earlier that wave B kind of depends on wave A, right? So, and this is why. This is going to give you what type of wave B is going to happen. So if wave A, guys, is a flat type of correction, right, meaning it's a consolidation, didn't really go anywhere, then wave B may be the zigzag type of correction and vice versa. If wave A is a zigzag, wave B is going to be the sideways, okay? It also states that if the correction begins in a more simple wave for wave A, then expect the following waves B and C to be more complex. And that's when you get into some of the different types of correction patterns and technical correction patterns and stuff like that. Now, the guideline of depth within corrective waves. This is a big one, guys. This guideline right here lets you know if it's in a correction or an actual trend reversal. Okay. So when the market goes into a correction, like a major correction, it will often correct to the territory of the previous wave 4 of a lesser degree. So remember, wave 4, guys, is a correction wave. This does not necessarily mean that it will reach the bottom of the previous wave 4, but rather that we should expect it to reach the span of the previous wave 4 to a lesser degree. So it's often a good place to find for the market to find support or resistance or market structure, right, before the trend moves on. Now, if the move extends beyond wave 4, look for the current move to be a change in trend. So if you see point C in the correction, if you see those candles closing below the lowest point of wave 4, guys, look for that current move to be a trend change. Now, what's Elliott Wave's relationship to Fibonacci, right? That's a good question. Now, if you guys know, a lot of traders have already, have their predetermined stop loss and predetermined take profits. And this is why, we're able to have those types of predetermined moves or predetermined orders in, right? Because the market, like I said, it likes symmetry. It likes to be balanced. So what is Fibonacci though? So the Fibonacci ratio of the 618, which is the golden ratio, was made famous by a 13th century mathematician named Leonardo Fibonacci. So what it is, it's the sum of two numbers based on a number sequence. Adjacent numbers forms the next higher number. So in parentheses, you have 1 plus 1. Those are the first two numbers, always 1 plus 1. Those equal the next number in the sequence, which is number 2. So now you move over one spot. So 1 plus 2 equals 3, which is the next number in the sequence. And it just keeps going, basically. That's what Fibonacci is. The 618 or the 0.618, guys, is often referred to as the golden ratio or the divine ratio because it has been found throughout nature, such as the breeding patterns of rabbits, our DNA double helix, and how petals form on a flower, and proportions of the human body, or in a galaxy spiral, and so forth, basically, right? Now, the 5 waves of a modal phase have a Fibonacci relationship with the 8 waves of the complete cycle. Okay. Each wave or phase tends to have a Fibonacci relationship with other waves or phases. Thus, a retracement is often close to the 3.8. The 0.382, which is 1 minus 618, or up to the 786, the length of the modal phase. And we'll cover Fib later on here in a sec. Okay. So let's look at this graph to the right, guys. To the top left, it says wave 3 equals the 1618 times wave 1. So if we look at wave 1, wave 2 retraced to the 618, okay, which is 61.8% of the full 1.0. If you add that retracement to the full move of wave 1, you'll get the length of wave 3. And that's the top of wave 3, guys, is where our take profit would be at the 1618 or the negative 618, right? It also says wave 5 equals blank wave 1. Look at that. It's wave 5 is equal to wave 1. That's the guideline of equality, market symmetry. It says wave 2 equals the 618 times the length of wave 1. And then you have, so the 0.618 times wave 1 is going to give you the 61.8%. It also says wave 4 equals the 0.382 times the length of wave 3. And that's going to give you a 382 retracement. So notice though, again, wave 2 and wave 4. Wave 2 came down to the 618 as far as the retrace. That was a deeper retracement. Wave 4 was a shallow. It only retraced to the 382. That's the guideline of alternation. Let me see. I know we got some questions, so hold on. Let me check it out.
Yo, can you explain that again? You kind of lost me.
Yeah, I can. Yeah, this is gonna be uploaded to YouTube, guys. So
Yeah, I understand Elliott waves, but the ones and adding 1 to 3, yeah, I got lost.
yeah,
I
no
understand
problem.
what it is, but I guess breaking it down, I don't know.
Yeah, so here's how you break this down. So wave 1 is from the low to the high of wave 1. That's 100%. Okay. Wave 2 retraced 61.8% of wave 1. That's where the 0.618 comes from. Okay. Now, if you add the length of wave 1 and the retracement of wave 2 together, you'll get the approximate length of wave 3, which is 1.618. And that creates an extended wave. Now, the top of wave 3 is where we have our predetermined take profit based on these ratios, because we enter in between the 618 and the 886. So if we know that, hey, wave 2 or wave 4, since we enter in on a retracement, right, is that deep or that shallow, then we, based on Fibonacci and how it relates to life and all that we do, that's why we're able to have confidence in those predetermined take profits and stuff like that, because the market, again, it loves to move and you know, it likes to move in balance. It likes to stay balanced, basically, in market symmetry. So to get to wave 4 and wave 5, the length of wave 3 is 1.618, which is 161% basically of wave 1. Wave 4 did a 38.2 retracement, or a 0.382 retracement of wave 3, right? If you, where's it at? Yeah, so that's where you get the, if on it where it says wave 4 equals 0.382 times wave 3, that's just going to give you the percentage of the 382. And it's all relative, basically. So, I mean, you don't necessarily have to worry about, you know, that math right there, anything like that, guys, but just understand, due to Fibonacci and how it relates with Elliott Wave, that's how we're able to confidently, you know, hold trades till one of those to take profits, basically. And again, we'll cover this in Fibonacci, guys, later on down the road. So don't, you may be confused right now, but after Fibonacci, you shouldn't be. And actually, we're getting into Fibonacci retracement right now. So this is the golden ratio, guys, in our entry zones. And again, our take profits and how we set our stop losses. All right, so what's the goals of Fibonacci, guys? The goals is to learn the golden ratio. It's to learn the retracement levels, how to react, build confluence, learn A, B, C, D. A is a swing point, B is a swing point, C is your entry, D is your take profit. And then, of course, harmonics is going to be in the continuous education later down the road, not in the beginning class. So again, real life application in the golden ratio. So Fibonacci, guys, it constructs geometrical patterns, and Fib is found throughout the world, from life forms to buildings. It's used to find high probability trade setups on multiple time frames, right? And again, the Fibonacci ratio of the 618, guys, that was made famous by the 13th century mathematician Leonardo Fibonacci, and it's based on that number sequence. And again, like I said, it's often referred to the 618 as the golden ratio or the divine ratio, because it's found throughout nature and all kinds of things, right? Now, the picture to the right, that is basically Fibonacci kind of explained to you. So you've got all these different numbers, starting with the body from the hand to the feet, right? On the left-hand side, you've got 0.382 and 0.236. Those are two different Fibonacci retracement levels, okay? If you add those two together, they equal the 0.618, all right? Now, if you cut a body in half, you should have two equal length parts basically at the waist. And that's what this is showing you right there, where it says 1.0 on the right hand, then you got the 0.618 and then the 0.382. That is trying to show you guys how balanced the body is basically. So if you cut us in half at the waist, you'll form two equal parts. If you cut us in half from the elbow at the top of our heads, the length from your elbow to the tip of your hands or your fingers should be the 382. Now, if you add that 382 to the rest of the top half of the body, which it should be the 618, you will get 1.0, or equal length from your half to your feet. And that's what basically, that's what Fibonacci is in as far as like the real life application, right? So when we use it on charts, guys, since it's found through all aspects of life, it's going to be found in, some aspects of trading. And that gives us added confluence or confidence to enter these trades, hold these trades to certain levels. Now, here's the relationship. Again, in Elliott Wave, the 5 waves of a motor phase have a Fibonacci relationship with the 8 waves of a complete cycle. Each wave or phase tends to have a Fibonacci relationship with other waves or phases. Thus, a retracement phase is often close to the 382, which is 1 minus the 618, or up to the 618. Did you go?
Yeah,
Oh, good looking. Oh, man, you the man, bro. I appreciate you, man. Straight up. I
Hey,
appreciate
Corey,
Yes,
I
ma'am.
have a person trying to get in. I just forwarded her the link. Her name is Laura, in case it shows up.
Okay, just a second. It just said she couldn't get in.
She should. If she's got the link, she should be able to get in.
Oh, he's back. Good looking, bro.
Yeah, I'm back. I've been back.
I had no clue.
Yeah, I'm here just typing away. I'm multitasking over here.
Dope.
But Debbie, just text me if she can't get in or something, or call me on my phone if she can't get in.
Okay.
All right.
Oh, that's fire. French fries. So, excuse me, guys. That's the first bite I've had to eat all day. Fibonacci relationship with other waves or phases. Thus, a retracement phase is often close to the 382, which is 1 minus the 618, or up to the 0.618, extending all the way to the 786, which is kind of like a custom, or the length of the motor phase that you're basically measuring against. The process of price discovery follows a similar fractal structure. This sentence, the next price is always a function of the previous price in any market, even at the open. That's what I mean, guys, by market symmetry. The market loves market symmetry because the next price is always a function of the previous price. So when we are looking to enter the market, guys, after you have determined what wave you're in, it's important to understand that, the retracement characteristics of the different fib ratios. So what that means is, after you recognize price as rejecting at a certain fib ratio, right? What to expect after that, right? What comes next? So knowing what kind of retracement the market is in will help you judge when may be a good possibility to re-enter or enter the market. The market retraces again to the minimum fib level of the 382, and at most to the 886 with a little overshoot at times. If the retracement retraces more than the 886, guys, basically if it retraces 100% and you see candles closing below that structure or above that structure at the 100% level, be looking for the trend to continue in that direction. Now, Fibonacci retracement characteristics, okay? This is where we get into the A, B, C, D. Understand that A and B, guys, are the swing points that you're measuring, or the impulse wave that you're measuring. C is our entry point, somewhere in the lines of the 618 and the 886 where we want to enter, and then D is going to be where we take profit. All right. So there are 3 Fibonacci retracement zones that we particularly pay attention to. 2 zones where once the market reaches, we're looking to enter or re-enter the market, and then once these retracements are reached, each of the moves after them have their own characteristics. So pending orders is what I use, guys, most of the times, because I trade the Asian Tokyo session. Like, I go to sleep, set and forget, right? So I use a lot of pending orders. Understand, guys, again, Fibonacci, this is all extra confluence, right? And honestly, in order for you guys to understand harmonics, you need to first understand Fibonacci. So what are the different moves of the retracement characteristics, right? Or the moves after retracements. So if you see that the market has retraced to the 38 or the 382 and found its support or resistance, right? And you're going to enter, expect the move or the wave after that to be super aggressive. It's going to be real sharp, real steep. 50% retracement produces a medium bounce speed. And a 618, which is, again, guys, a golden ratio. That's the first ratio that we actually look for entering or re-entering for a trend continuation trade. Again, pending orders go here or halfway between here and the 786 ratio. The 786 is where you put your pending orders if you want to try to get like wick entries. All right. And then again, the 618 and the 270, guys, are the extension levels and targets for the trend to continue. So let me start to put this together with you guys, okay? If we're entering based off the retracement of an impulse move, and we understand that current price is reflective of the prior price movement, right? That's already telling you that using Fibonacci, again, what to expect as far as a take profit. Now I'm giving you, once a certain type of a retracement level is reached, what to expect as a move out or away from that type of level to your take profit, right? A, B, C. Again, let's cover this real quick. A, in this picture right here, A is swing low, B is swing high. In a downtrend, A would be swing high, B would be swing low. A and B, guys, the move from A to B is your impulse move. The move from B to C, whoa, look at that top floor. The move from B to C is a retracement against that trend. The move from C to D is the fib extension and the other or the next impulse wave. So looking at this picture here to the right, we got A at the low, B at the high. We enter, as I told you guys earlier, in between the 618 and the 786. So if we're expecting that entry, we can honestly expect a pretty slow move away from that, away from C to our fib extension at the point of wave D. Okay, so now that I'm giving you guys realistic expectations for, when, or I haven't really gave you a time frame, but I'm giving you guys characteristics of the move after you enter, right? And this is why sometimes people may close their orders a little bit early if they find that it moved a little bit slow. Now, understanding that depending on if you're in wave 3 or not, you're going to have your own separate miniature 5-wave series within that one wave. So they'll close early and prematurely, when those retracements are actually prime opportunities to stack your trades or re-enter, right? And I'll show you this all on the charts, guys. So how do we apply Fibonacci on the charts, right? Again, we began by drawing from a significant swing low to a swing high on a bullish trend, or from a swing high to a swing low on a bear trend. From point A to B, guys, is an impulse wave of Elliott. So we'll say that's wave 1, right? From A to B is wave 1, wave 3, or wave 5. B to C is going to be a retracement wave. So that's going to be waves 2 and waves 4. C to D is going to be the continuation to the fib extension levels and also another impulse wave. So what that means is if we see AB as wave 1, BC is going to be wave 2, C to D is going to be wave 3. So the strategy that I'm teaching you guys teaches you to catch full waves, basically, guys, right? Once the ABC is complete, once your take profit is hit, guys, you can redraw your fibs. So now, since we fibbed wave 1, and wave 3 was the top of our take profit, we're now going to fib wave 3 to enter in at the end of wave 4 to catch all of wave 5 to our take profit. And I'm hopefully, if you're taking this the second round, guys, this is like a bingo, because I don't think I said that the first time.
So let me ask you this, Corey. So you take the Elliott, the fibs, and you would go from wave to wave with the fibs?
Starting out, yes, ma'am.
Huh. Okay.
And I'll show you this in the charts.
You're going to do it on the charts so we see exactly what you mean?
Mm-hmm.
Awesome.
I had to get a French fry in there. Hold on, guys.
I can tell you drinking.
Yeah, that was dry right there, boy.
Yeah, you just been talking.
I know.
This is awesome.
Let's see. Let me see what else I have to cover with you guys first. Hold on. All right. So that's all for the slideshow tonight, guys. But before we go, I want to show you this cheat sheet right here. So hopefully this helps make sense a little bit better, right?
It looks like gibberish, guys, but this will make a lot of sense to you guys once he goes in depth, like Professor Wallace does.
I'm going to draw it for you guys tonight, actually. But this is a cheat sheet. So the light blue, guys, would be like your major structure points.
Screenshot, guys. Screenshot.
Definitely. So the light blue, guys, is the major trend, okay? We always tell you guys to follow the overall and the major trend. Using the triple screen system that I've got for you guys, notice that you've got the light blue, the green, and the black lines. Those are 3 different screens, meaning those are 3 different time frames. So here's what happens, guys, okay? So in the light blue, that's going to be, let's say, if we find our structure chart, right? The structure is going to come between either the daily, the 4-hour, or the 1-hour chart. So for this example, we're going to say we see structure on a 1-hour chart. So that light blue line, guys, is the 1-hour time frame. So based on what we just covered, we're looking at a wave 2, basically, right? On the major time frame. So we would fib from the bottom of that light blue to the top of that light blue and see where the bottom of wave 2 is basically making that that higher low in this model, right? Let's say it's in between our entry zone of the 618 and the 886. Cool. That's telling you guys, hey, price is at some type of structure or support or some type of entry zone. Now what we do is we use time frame correlation. Since structure from the light blue line on this chart, we found that on the hour time frame, our entry setup is going to come from the green line, okay, on the 15-minute chart. So again, the light blue is an hour. The green line, we're looking for our entry setup chart on a 15-minute chart. Once we see basically the Elliott wave on that chart and it's aligned with the 1 hour time frame, right? So just look at the green line for a second. You guys see the complete cycle of the green wave. Let me X out of here. Can you guys see my mouse right here?
Yes.
All right, cool. So from this low to this high, that's wave 1. This is wave 2. This is wave 3. This is wave 4. This is wave 5. This is wave A. This is wave B. This is wave C. Where does C coincidentally align with? Wave 1, wave 2 from the 1 hour time frame, right? Cool, that's alignment, guys. That's more confluence. Now what we do, we go to an even lower time frame, guys, okay? Which is the black line. So since the 1 hour is the light blue, 15-minute is the green, this black is either going to be the 3 or a 1 minute time frame. And as you can guys clearly see, wave 1, 2, 3, 4, 5, A, B, C. 1, 2, 3, 4, 5, A, B, C, D, E. 1, 2, 3, 4, 5, A, B, C, D, E. Now, on this move right here, on the lower time frame, guys, since it broke this structure, this wouldn't be lettered A, B, C. This is going to be 1, 2, 3, 4, 5. This would be A, B, C. You see how this retracement aligns with this retracement, right? But now you've got 1, 2, 3, 4, 5. After 5, guys, what do you expect? A retracement.
Bullish, right?
Right, but for this instance, I'm just going to say a retracement, right? Because we're in a downtrend on the black. So this is a retracement to go bullish. So that's one chart that aligns to go bullish. The green is an ABC retracement, right? From the bull trend of the higher time frame. That's 2 charts now that say go bullish. Then you've got your overall time frame on the light blue that you know as wave 1 and wave 2, right? That's 3 charts, guys, that again tell you to go bullish.
I need to see it on the actual chart. You know what I'm saying? Actual.
I know you do. I know you do.
Cause just hearing you saying it, I don't know how to put it on the chart like that, bro.
I know.
You'll see it. He'll get into that in depth.
Yeah, let me get a fry in me. I'm going through the charts now, guys. So hold on.
Cause I hear what he's saying, but it's like I gotta see it.
Boop, 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 boom. Where's my chart at?
By the end of the 3 weeks or whatever, the 2 or 3 weeks, all of this will definitely come together for you guys for sure.
Oh yeah.
Oh hell. Oh hell. Giving away sauce.
Free sauce, free sauce. So this is triple screen, guys, right? Now, I haven't gone over triple screen in depth with you guys just yet, but just know that it's based off of a time frame correlation, and it's kind of covered in a book that I'm going to release for you guys, or release to you guys. I'm going to release the PDF basically, like it's free, right? Like I said, I can't charge you guys for free shit. It's already out there. You just got to know when to use it and how to use it. All right, so I'm coming to the charts, guys, again, there's 3 charts that I have to pick out. A structure chart. I have to pick out a time frame, not time frame, structure chart, a entry setup chart, and then my candlestick entry chart. Those are the 3 charts that I have to pick out. Those 3 charts are also correlating with each other. Okay, they're based off of time frame correlation. So this is why I say, you know, I always start on the daily, the 4-hour, and the 1-hour charts. The reason why I do that is because I want to, first of all, take a look at the daily time frame just to make sure, you know, hey, I'm going in a line with the trend for even the trend for the day. Not only that, I want to be mindful of any type of daily type of structure. So this is already marked up. I'm not really going to use UJ. Let me find something else for you.
How about EU?
You know, I don't really trade EU, but I will trade EU.
Thank you.
You're very welcome. All right, so now you're probably like, how do you set this up, right? Now I'm using a paid version of TradingView. And the reason why I use TradingView over MetaTrader 4 is because, first of all, I'm on a Mac. I don't want to go through all that hassle. And the second reason is because TradingView is such a much more capable trading program. I believe Thinkorswim may allow you to do it as well. Don't quote me on that though. Thinkorswim you can get from TD Ameritrade, by the way. All right, so this is triple screen, guys. I've got my chart to the right on the daily, my chart in the middle, the 4-hour, and then my chart to the left, the 1-hour. What I'm looking for is where can I identify parts of the cycle the clearest, right? Let me type this out for you. When looking at the daily, 4-hour, 1-hour, I'm looking for which chart can I?
So you look for the Elliott wave before you do anything?
Yeah.
Wow.
Because just think about it. If you know the characteristics of a wave you're in, or if you know what kind of wave you just came out of, you can always, you know, be on the, well, not, I'm not gonna say always, but more times than not, you can be on the right side of the trade.
Right, right.
So that's why, you know, I see where can I identify, you know, Elliott wave the clearest first, because that's going to help me identify other parts of it, right? And then once I identify that, you know, then I identify the most recent breakup structure, which I'll cover tonight for you. We'll call this BOS.
I have an unpopular opinion.
Yes, sir.
Those 3 charts throw me the hell off when you have them on, man. Like, can we go like from chart to chart, you know?
Yeah.
That'd be great. Thank you.
No problem, G. My bad. I'm just used to looking at it now. All right, so then we look for the most recent breakup structure where we feel price should reach. And then structure where we feel if price was to reach in the opposite continue, stop loss. All right. Boom. So first of all, let me do this. I'm gonna start EU all the way over. All right. Now, that's on the 4 hours. Is this on the daily too? All right, cool. So I'm starting from the daily chart, okay? I'm gonna show you guys this way. So that way you all can put it together. And again, guys, what I'm looking for, I look at the daily, the 4 hour and the 1 hour time frame every time. Okay? Every single time I look at a chart. The reason is because you're not going to find a trade every single time on the same time frame. So you check each of those out every time. Those also are going to determine what type of trade you're going to enter. Also going to determine or help you determine, how wide or narrow your stop loss is going to be. And it also is going to help you put some type of expectation as far as how long you can expect to hold that trade. So for instance, if I'm finding my structure on the 1 hour time frame, guys, that's a position trade. That's going to be held for days, probably, up into maybe even 2 weeks or so, if not a little bit longer. That's a position trade, right? That stop loss is going to be, anywhere between 50 and 100 pips.
On a 1 hour?
On the daily.
Oh.
Yeah, on the daily.
On the daily, you said 1 hour.
I'm sorry. Yeah, so if I find my structure on the daily chart, guys, my bad, I'm sorry. Thank you for correcting me. Then, that trade, guys, again, is going to take days to maybe potentially even weeks to play out, right? Or even to hit your take profit and so forth. So that kind of gives you like a realistic expectation that, you can breathe. You don't have to monitor that trade. You've already got your stop loss, your take profit, and it's already entered, right? What's the worst that could happen? You lose some money? Who cares? If you're using the right risk management, none of that even matters. So that allows me to, as a person, to, set and forget because I'm following my risk management. And then more times than not, I understand that, I'm going to be winning. It's going to balance itself out with the proper risk management, right? So that's why I look at the daily, the 4 hour, and the 1 hour time frames every time. Because again, it's going to determine what type of trade I'm entering, and it's going to vary from day to day. So looking at the Euro USD, starting out on the daily time frame, first of all, what I see is rejection up here at my key level. Okay. So I see that already. Now I see the lower high. Then I see an even lower high. So I'm going to mark all this up, guys, right? I want to delineate this stuff. And I've got all of my tools color-coded so that way I understand, if I'm on a lower time frame and if price is approaching this structure again, I can immediately tell what type of structure that is, right? It's convenient. Let me do this one. And I'll zoom in a little bit. All right. Now, here's what I'm about to show you guys real quick. If you saw this move, our entry is in between this zone. It actually pinned up to the 618, which is fine. Your first take profit, guys, is the 272. Your next is the 618. Almost all the time, this 272 is going to get hit. Okay.
I so hate to interrupt you. How come you only went down that far though?
To this right here?
Uh-huh.
Because I wanted to show you guys this move. Because again, if we saw this move, we let this retracement happen and we enter over here. And then we hold it to these predetermined take profits. And this is why, because you catch this full move. And that's why we enter on retracements, because you're going to catch a full move.
Do you go with the wicks or with the bodies? You went with the wick.
Yeah, I paint my Fibonacci's off the wicks.
But where you ended it isn't on a wick.
Yeah, I did on this one. Right here.
Oh, off that one. Okay, gotcha. I'm sorry.
So I'll measure this move against this move so we can catch this one. And I'll show you again on a different example. Matter of fact, this example.
Maybe
right
just make the candles longer. I can't see.
Pull it up for you. All right, here we go. So
Thank you. That's awesome.
So here's what we do, guys, right? If you guys take Ryan's class, yeah, he looks for what? The retest or rejection? Wait, what did you say? Retest, rejection, react, right? Or something like that.
Yeah, that's it.
That's it, right? Yeah, I think that's what he says. So I'm about to show you guys the retest, the rejection, and why we react, right? So going back to the ABCD, right? Let me point this out for you guys. Oh, get off of there. Boom. So A's at the swing high, B's at the swing low. Wait, from B to C is the retracement of this impulse right here, or whatever trend this is right here. And then our take profit is D. That's the ABCD I'm talking about, okay? So don't confuse that with like an ABC retracement, but this is the ABCD. It's actually referring from the swing low to swing high, the retracement, and your take profit.
What made you not use a 1, 2? Oh, because it's going down.
No, well, not necessarily because I'm going down, but this is just how we notate the whole trade itself, basically, not necessarily a correction.
No, I'm saying what made you not use a 1, 2, 3, 4, 5 in that versus A, B, C, D, and E? Yeah, if that's the Elliott wave, it's not the.
This isn't the ABCD isn't Elliott wave. That's just notating the trade, the whole trade itself. So A and B is an impulse wave. B and C would be some type of retracement, and then C, the D, is the whole thing. So let me go back to this right here, and you'll see it. I'll show you on the slide too, right? I showed you guys A, B, C, D. Let me pull this back up.
I'm sorry, I hate stopping you, but I had it, and then all of a sudden I feel like I'm lost.
Can you see the slides now on my screen or no?
No, just your chart.
I'm sorry, hold on. All right, so you see it now, right?
Yep.
All right, so A, B, C is our entry, D is our take profit, right? A is at a swing point, B is at a swing point, C is going to be on our entry box, D is our take profit. Now, going back to the charts, A is at a swing point, B is at a swing point, C is at our entry, D is at our take profit.
Got it.
Got it?
Got it.
Cool. So let me get that off of there. I just had to show that to you guys because I knew that was probably confusing using A, B, C, and D, and then A, B, C. So that's why I wanted to. I'm glad you actually asked that question because I'm pretty sure a couple other people probably confused as well.
I can't help it. I have to ask because I sat for so long quiet, and when you don't understand and you just can't move forward, it's just, you know.
I already know. So I take an online coding class, and it's pretty intense, right? And let me tell you, I'm a pretty smart guy, but sheesh, if I'm gonna ask those questions, I'm lost.
Right, you have to, right?
Now,
I hate that I'm the only one, though.
I do too. I wish other people ask questions because it'll help other people.
No, Deb, trust me, you're asking for a lot of people. You just beat them to the question, you know. So they're gonna let you do it. You just been given power. You know.
A lot of us simply can't formulate the questions yet.
That's probably true too. All right, so getting back to the retest, rejection, react, right? So since this is the ABCD, right? And I said earlier that once you see the ABCD is completed, you move your fibs. This is why we go from this fib got us to this ABCD. Now we can fib again from this same impulse, right? Or not the same impulse, from that next impulse. This is actually the CD leg that we're actually fibbing now to find out this retracement.
So that you went from top to bottom.
Yeah, because we're still going down.
Okay.
So let me draw this ABCD again, right? A, B, C. We're expecting D to hit somewhere down here.
How you know that's not gonna go up though?
Not how do I know what's not going to go up? The trade?
You say it's still going down.
No, he's just using the fib to get an idea of where it could retrace to.
Right, but he's asking how do I know like it's not going to go up from right here? The reason
Right.
why it's going to go down is because you've got, again, we're on the daily time frame. I see this rejection off a hard key level up here.
Okay.
Right. Not only that, I see this is a double top right here. This is a lower high than this. This is a lower high than this. Not only that, I'm looking at rejection off of a daily key, off of a daily structure level with this orange line with a hammer, right?
Oh, okay, gotcha.
That's a hammer right here. So if I fib from this low, I mean from this high to this low, this hammer came in at our 886. I mean not our 886, but our 786 area, I believe. In between, basically.
Are you selling when you see that hammer right there?
Right here?
Yeah.
If I see a hammer and then this next candle is bearish like this, yeah, I'm definitely.
That's basically a evening star, isn't it?
Yeah.
Oh.
Yeah. So let me get back to boom, highlight this for you. So it's in between our 618 and 886 sell level, right? Again, guys, everything that I'm marking up is called confluence. All things that add confidence in the trade going in my bias favor. So I see this hammer, this 3 candle formation right here as a short sell move, okay? Now, again, this is on the daily time frame. So since we've seen that it rejected off of that, and yesterday was pretty bearish, right? Again, guys, I'm still gonna mark it up like it's a lower time frame. I'm looking for the same stuff. Ooh.
You enter right there, and that'll be your stop loss where the cross is at right there.
No.
Take profit.
No. It could be your first take profit if you don't want to hold it.
I got you. Okay.
Yeah.
Well, I'm just going off of my account. That would be where my take profit would be at right there, because if it go past that means structure has broken.
Yes, sir.
Gotcha.
So here's what we're doing. Boom. I'm going to show you guys, like, if this was me entering like today, right now, properly, I don't think, well, I understand that realistically, I can hold this trade all the way to this right here, this red dotted line. My first TP is going to be right here. So since I'm seeing this structure on, I keep forgetting my toolbar's down here. Don't you dare. So this is my risk to reward ratio for right now. It's 2.5 to 1, basically, right? I can modify this a little bit. Take off my fibs. Again, I'm on the daily chart. What I see here on my daily
your head and shoulders.
Right. You got a nice little head and shoulder forming. Well, shoulder over here, couple of heads, another shoulder. Boom. It came to our neckline, already broke it. This now, I need to show you guys what a break of structure is, okay? A perfect break of structure. What do I mean by break of structure, right? Earlier I told you guys, in order for a structure to be broken, it requires the body of the candle to close, right? Above or above or beneath it, okay? Now, a perfect break of structure, and I'm giving you guys some nuggets tonight. Where's my text? Perfect.
Get it.
Fire.
Get it.
Dude, I've been snapshotting and printing for the last hour.
Well, it's been here 30 minutes. You got another hour and a half.
Oh yeah.
So instead of entering, because it seemed like I see where you got your long or your short tool at where that's your entry. So instead of entering where the hammer is, you enter when that long candle closes.
Correct. Now remember, this is on the daily time frame, so I'm technically not even entered yet. Okay.
Yeah.
Okay. So when you go down to a smaller time frame, you'll get a better entry. I got you.
There you go.
Man, we learning over here.
There you go.
Wait. 50 right there, though.
I can't hear you, Kenny. Uh-oh.
You're breaking up, Kenny.
I feel good about entering when that 50 is sitting up.
Boom. I still couldn't understand him. Could you?
Yeah, he was breaking up still.
Oh.
Saying that, how would I feel good about a sale if that 50 is sitting up under me?
I'll tell you why. We're not done yet, bro. We're not done yet. Now, so here's the reason why I feel comfortable with entering, even though it's above the 50 EMA, guys. Okay. Again, keep in mind that EMA is a lagging indicator. Okay. The methods that I'm teaching you guys is based on price action. You'll be able to read and see the move before that EMA does.
Yes.
I'm telling you, baby.
I teach you guys price action methodologies, and those are some of the best methodologies that you can use when it comes to trading, because you're actually reading what the market is doing and you're reacting to it.
And on a smaller time frame, your candlesticks might be below the 50 EMA.
Oh, we'll get to that. We'll get to all that. Y'all just sit back tight. So, a perfect break of structure, guys, requires three or more candles. Okay. The big thing with two of those candles being in your bias favor. Now, you're like, Corey, what do you mean by that? Let's take a look at some breaks of structure real quick, okay? Now, this right here, this orange line is delineating a support from over here, okay? Y'all see this? Support, support, support. This candle broke that structure. This candle closed below that structure. This is your third candle. Let me zoom in because to understand how petty the market is, guys, you have to realize that sometimes these candles, they won't even look like they're closed above or beneath that structure. Like they'll close 3 pipettes above or below. The brokers in these markets will. And so sometimes you have to zoom in, right, to see that, you know, that candle actually closed beneath that structure. That's my first candle that broke the structure, okay? Look at the body of that candle. It's got some type of momentum to it. That's my first candle. My second candle also broke this structure and stayed closed beneath. It's got some volume to it. Okay, that's 2 candles in my bias favor for the short. All right, now this third candle is simply a doji or a spinning top. 1, 2, 3. That's a clean break of structure. Now, understand that we have a high, a lower high. So since this is the most recent break of structure from this lower high, all of this is just a retracement until either this high or this low is broken. So what we did was we filled from this high to this low, looking at this as a retracement, expecting us to continue the prior trend, which is the downtrend. You see how that works? So not only that, since we look at this as a retracement, we've got this counter trend line right here that was broke. This hammer, or this 3 candle formation right here, came within our entry zone short for the trend continuation. So all of that already is telling me, yo, go short, right? So now it just becomes a matter of what time to enter or when to enter and how. So
if you don't mind, could you put up the field?
Yeah,
so I can see where the retrace to, because it's gonna have to come down and break the structure
Probably
down.
the 7-8. I'm thinking 7-8.
It retraced in between the 618 and the 886.
Yeah.
what was our entry zone.
Uh,
You see how that? Not only that, it retraced in between our entry zone at the structure that was broken, at some type of structure that was broken. So at this top line, this top orange line, let me get rid of this fib real quick. This top orange line right here, guess what? 1 candle breaking structure, 2 candle breaking structure, 3 candle breaking structure, right?
money in the bank.
Money in the
Nuggets.
bank.
Nuggets.
So we're looking at this again as a retracement. And what happens? It comes down to it. Price always, guys, has to validate structure that was broken.
So now if you get your next red candle, that's your third, that's a third candle and a break of that structure.
Right. So this is all on the daily chart, guys, right? That doesn't necessarily mean that, you know, hey, I'm ready to enter this bit. No. The dailies tells us that our bias should be short. That's all the daily is showing us right now. We found structure, we found all types of stuff like that. The daily show you, you know, hey, that our bias is short. Now, I'm still going to look at the 4-hour chart just to see what I can see, right? Let me go back to my normal view. Again, this is a different view from what we've seen on the daily chart. So I'm going to see, can I count my Elliott waves, right? Can I see my Elliott waves? Anything like that, anything of the sort. Since we're expecting this low to this high to be a retracement of this high to this low, right? I can, again, fib and show you guys this. Price, again, in between the 618 and the 886 actually came up to our 786. Came to the bottom of that structure. Now we're moving away, right? Now I can kind of fix I'm going to leave that line there. And I'm just going to continue drawing, guys, right? Just draw my structure up. What do I see? And if I see, you know, if I can honestly see all of the structure the clearest on all 3 of my high time frames, the 1 hour, the daily, and the 4 hour, I'm going to choose which type of trade I want to take. Do I want to take an intraday trade? I'll do it on the hour. Do I want to take like a swing trade? I'll do it on the 4 hour. Or a position trade? I'll do it on the daily. But I like to enter immediately, right? I like to enter as soon as possible, sooner rather than later. So, you know, I'll probably use the 4 hour or the 1 hour for this next trade, for the trade on this EU, basically. Now, I can either leave this orange line here from the daily there, or I can redraw it. I think I want to redraw this because this is actually, guys, a channel. Boom. All right, so what do we have already? We've got this channel that was already broken by a nice break of structure, right? More structured breaks, single candle break, second candle, third candle. Notice though, what's happening on these third, fourth candles? They don't have too much volume with them. They don't have a lot of momentum. That's a-okay, given the time frame that we're looking at this chart. It's 9:30, guys, at night. This is the Euro USD. Most movement on this pair doesn't happen until closer to London. Now, here's what I will say. Since we are on the 4 hour time frame, I want to use the 4 hour time frame, guys, as my structure chart, not necessarily the daily. Okay, I'll reference the daily just to see, you know, what's going on for the day. Yesterday was pretty bearish. I'm going to expect today to be pretty bearish. Okay, all my momentum is bearish, right? Now, what I want to pay attention to is this wick right here and where this candle closed at. And this is a good example, actually, of how petty some of this stuff is. So, and this is why I use wicks, guys, because, again, I'm going to reiterate, use the wicks because those are indeed lows and highs. Like this, the wick right here is actually a low, even though the candle closed up here. This is a low. This is letting you guys know some type of structure may be right there. And I want to delineate that. So notice though, this line is at the low of this wick. These candles closed higher than that still. If I was to draw this line all the way over, Look at that. So because that this is only a single candle of nice momentum against this right here, this channel, this bottom channel, I need to find where or what candle that this candle broke through, or what structure this candle broke through, right? You just look to the left. You can use this low right here. And again, I use the bodies. When it comes to breaks of structure and closing of candles and things like that, we're going to use the bodies. When it comes to, how can I word this without confusing you guys? So this wick is historical data. This is current price data. When it comes to looking at market structure and stuff like that, I'm going off the tip of the wicks on historical data. If it was wicking right here, and like it is right here currently, and current data, that's letting me know that, yo, this may be some type of support on the lower time frame. So what I could possibly expect is from this high to this low, a miniature ABC correction. And this goes all back in between cycles within cycles, right? Let me pull this up. Hopefully you're catching this, T-Bass. So I don't know where B is going to end. It may not even end right there, but you might see something like that happen before the next push down. Let me fib. I'll fib from this high to that low. Look at there. Let me bring this back up. Let's say I enter in right here. Now that trade becomes, holy shit, zoom out, bro. It's so wide. Now that trade went from a 2.5 to almost a 5-to-1 risk reward ratio, right? That's just because I'm just walking my trade down, guys, right? Just moving some stuff. So let me get that fib off of there. Let me get, oh man. Get this fib off of there. Keep that on there. Now, this is on the 4-hour time frame. I can use this data here on the 4-hour time frame, or let me take a look at the 1 hour and see what's happening on the 1 hour, right? Oh man, look at this. Now I can really hone in on a nice entry. So this, all a channel or a trend line is, guys, is diagonal support or resistance, right? Again, breaking structure, 1, 2, 3 candles. Y'all see that, right? Even this 4-hour breaking structure, 1, 2, 3 candles. So comfortably, I see this A leg already happened. B should be more of a zigzag, and then C should pop back up. What I can do now again.
Would you have a W form?
You would have a double bottom right here. And then, so what happens is, though, people will see that double bottom, and then they'll catch this C. And then they'll think that, you know, hey, it's going to continue to go up, though, and then it shoots right back down. Now, what we have to understand, guys, is the daily and the 4-hour both showing us that it was pretty bearish, right? Now, this is why we enter on the retracement. Because once you catch that retracement, you catch the full move out of the next thing. So remember, we got our entry shadow box from the daily time frame, right? I haven't moved this line right here for the entry. I haven't moved that at all. So coincidentally, though, it's right in alignment with our entry box, the bottom at our 618. So that's, I want to delineate that. I can then shorten my stop loss again, right? Now what this trade turn into? Probably something pretty fucking scary. Oh, come on now. Where am I at? Where am I at? Daily. That's a 7.5 to 1 risk to reward ratio, guys, right?
You guys understand why he was able to shorten his risk or stop loss? Do you guys understand why he was able to shorten that?
Wallace, I have a question.
Yes, sir.
When you fibbed, where the 1 is at, why did you choose that candle and not the other one that's a little higher?
This one?
No. When you're fibbing down here, yeah, right there, up where the gray line is at.
Right
your
here?
gray one up, go up.
Oh, right here.
Right. Yes.
Why did I not use this one?
The green one, there's a little high right there.
Right here?
There. Yeah.
I think I did.
Is it? It looks.
Right there. It's right there at it, but yeah. But that's a good question, and you can use either this point or this. Actually, I went off of this point. The reason why I went off of this point is I'm looking at this closes though as a lower high than this, right? So I'm going to go off of this right here.
You want to start it where the breakout. You want to start it where the breakout starts.
Right.
Oh, that makes a lot of sense.
Yeah.
There you go.
You always want to start it where the breakout's going to start, because some of that other stuff is there's a little bit of a retracement there. Then there's a little bit of inconsistency. So you want to usually start your fibs where the breakout starts, where the breakout trend starts.
Mm-hmm.
That might make me some money tonight.
Yeah, I'm looking at it as well, but I do have a question. Right where you put the ray, where that long candle had crossed the price channel.
On the bottom of the channel.
Right there where we're gonna go up.
The big vector candle.
Come down where the purple ray is. Right. Go up a little bit more. No, the other one. Right there.
This one. Yeah.
So why wouldn't you put that ray where that big candle crossed that trend line? Because you see right there is some dojis and a hammer right there where it crosses it. Right there. You wouldn't put that right there?
No, sir.
Okay.
If I extend this all the way to the left, we can see all the structure that it's actually at.
I got you. Okay. Now I see you. Cool.
All right, let me see.
Yeah, you can always confirm how strong a support or resistance is by going way back and seeing how many times it's hit. The more times it's hit, and much stronger it is.
Yep. So what we're looking for, guys, again, is we're already on the A. The A leg of the retracement has been complete. We're on the B currently, right? So I still, like I said, expect a push up to incite people to go long, okay? Now, keep in mind, like we said, from the higher time frames, we're expecting to go bearish, right? We're expecting to go bearish from the higher time frames. So since we want to sell, we actually want to see our lower time frame go into a long situation, because that's going to be the retracement from this high or this high, whichever one you want to use, and this low. We're just waiting for it to complete somewhere in this area. Now, going back to the training tonight, guess what? I also said that C can also produce you some profit, right?
Yes, sir. Yeah, because you got to remember, it also has that void to fill, that big vector candle void to fill.
Bingo.
Which is another confluence to that C retracement.
Yes, sir. Now let me point out something to you guys too.
Going back up.
Now that trend line is going to become a resistance as well now, where that C is.
Right. It'll be tested as well.
Yep.
So this is what we're looking for. Now, with it being 9:49 p.m., depending on how this part plays out, guys, shit, I might honestly even enter right now, just, accept some drawdown. But I know that this seed is going to be completed, basically. And
There's a lot of confluences that would say that it would go up.
Yeah, but it'd be too early to take a buy right now, right?
No, we selling.
Well, he
right
said, well,
now.
no. But Torrance, remember, he said with some drawdown. So
okay,
he's
that's
still
aggressive
thinking
move then.
it still could go down a little bit, but given on all of our confluences that he just went over, it should, not that it will, because remember,
Be a buy?
nothing always does. Well, it'll be a buy only upwards to where that C is.
All right, so check it. As new folks, I wouldn't recommend you guys buy.
No.
Right. 'Cause that's
just
aggressive
telling you guys-
move.
I was
Yes.
telling you guys, referring back to the training, the C wave or the C leg of a retracement is a good opportunity to catch a counter trend trade for some profit.
Yeah.
So me personally, just me personally, like I'll probably take this buy tonight. I'm not saying you guys can do it or should do it. I'm just saying me personally, I might take this buy and just catch this little move right here. Because again, guys, all we're trying to collect is what, 20 to 30 pips, right? And then compound on 30
That's
pips.
almost what, 60 or 50, if not 100 pips.
Nah,
No, that's probably somewhere. Probably
No,
about
this
30 to
euro.
40.
This
Let me
about 50, yeah. About
That's like 30.
say if I entered right there, I held it there. Yes, 30 pips.
30 pips at 3 lots. That's a nice.
Shit, 30 pips at a standard is still what? $300.
At a standard,
right?
300.
Yeah.
Yeah, but at the C, when they hit that C mark, you really looking for the sell though. But
Yes.
ain't nothing wrong because I
Yeah.
trade zone to zone. So
Let me show you guys something though. Right? So again, the Fibonacci guys levels work for everything. Okay, whether you're buying, selling, whether you're catching a counter trend trade, whatever. All I did was fib from this low to this high. Look where price actually pinned in between. It already pinned in between our 618 and 886. It's on top of 4-hour support in order for it to catch this C move. Now, again, with it being 10 o'clock, guys, at night, depending on how this candle closes, I still expect it to trickle down just a little bit. All right. And even if it doesn't cross the low of this wick right here, closes still low, you can I'm gonna enter. I'm not gonna say you. I'm gonna enter and catch this C move up. Especially I'll catch it. At least I'll catch it to the 618 right here. This is just a scalp trade or a short-term trade, guys. Right? Let's look at the risk to reward ratio to that real quick. It may not even be a good trade to take. Let me see. If it enters at the 618, my target's right there. My stop loss is still fairly close, right? That's a 2.5 to 1 risk reward ratio. Yeah, I'm gonna take that.
That's still nice.
It's 23 pips.
Yeah.
Guys, all we're looking for is 20 to 30. And
money in the bank.
Exactly.
So I have a quick question if I can.
Yes, sir.
Okay, so say you place that trade, right?
Uh-huh.
Okay. Now, would it be a bad thing since you already expect it after it, say it does hit your seed, okay?
Right.
To place an order for a sell there?
No, that's a great idea because that's the main order that we're actually going after.
Okay.
That's what we're telling you guys. That's what we preach for the newbies to do. We don't want to teach you guys counter trends and quick scalp moves. We don't want to get into all that technical entries right now. Right now, what we teach you is wait for the reach. The 3 R's. You guys are here, Ryan, say it all the time. Retest,
reject, and react.
Mm-hmm.
Boom.
React. Bam. So right now we're waiting for the retest. Okay.
Right.
That's what the C is going to be. Then we're going to look for the rejection.
Mm-hmm.
You know? And then when we see the rejection, we go for the reaction, which is you placing your trade.
Okay, so for me to place an order there would be correct. Even if it's wrong, it's still a right move because there's
Multiple.
opportunity for that for a sell.
Yes.
Correct.
And that's what I was about to say, because like for beginners, like I know a little bit, but I don't know everything. So it's still a retest, because you put the fib on there. It retested at what, 86, and if you catch it at that right point, you can still enter there, but you got to make sure you take your profit when it hit what, the 618 or whatever, whenever it gets to that.
Right. So let me walk you guys through this real quick. So understand, guys, that I'm on a different experience level, not like raggedy like that than you guys, right? So I kind of have a feel for the markets, a little bit stronger feel than you guys. So the move that I'm pointing out, I'm just simply pointing out that, and referring back to the training from tonight that I told you guys, this wave C is also a nice trade to enter on. So that's why I'm telling you guys, yo, I personally may catch this wave C, but you all as new traders have to realize that that's all that is just a ABC retracement. This is what you guys want to see before you guys enter to continue the major trend going down.
Yeah.
Correct. And that's why I say it's still, even the B to C is still a retest, reject to react on, but you got to be able to know, okay, I need to get out because I need to catch this move.
Yeah, you want to know where it's going to go to. So yeah, you definitely need to know that it's not going to go past. It probably won't go past the trend line. It's going to use the trend line as resistance. It also has those of you who have learned about void zones, that's right where that C is at, right where that yellow horizontal line is at, is also the 50%. It's also the 50% of that void fill, which is a huge. Those void fills are huge, very powerful. So that's like 4 or 5 confirmations or confluences right there that are going to tell you it's going to keep going in the downtrend.
Mm-hmm.
So, but you always want to remember, we're waiting for the retest to go back up to that zone, and then we have to remember you have to see the rejection as well. So you want to wait for the rejection, the candle rejection, before you were to get in on your sell.
Correct. Now, so what I'm going to do now is I'm going to shift from waiting for this sell to catching this buy real quick, okay? And I'm going to still use the same method, guys. You know, the time frame correlation. So to this real quick. Actually, let me just move it over.
That candle only has 2 minutes to close too on the 1 hour.
And look how it's closing, right?
Yep.
So again, all we do, guys, you know, fill from your low to your high. It already entered in our entry zone. We can ride up to our 618, about 23 pips or so. Probably will hit our C though. Now this is on the 1 hour time frame, so that would be considered our structure chart, right? Our entry setup chart comes from the 15-minute chart.
Look at that.
Mm-hmm. You know, again, it's clear from this low to this high, all of this. Going back to the trading, what happens? This is the A wave. Hold on, let me.
Right.
Wouldn't the A wave be the first one that made the first big move up? Why is that the A wave? Look to the left and go to the bottom of those green candles. Yeah, right. Wouldn't that be the A?
I'm talking, okay, so again.
Or 1 to 2, I mean.
Cycles within cycles, right? So from this low to this high, this is at one impulse. All of this is the correction. So going back to the training, this wave A is kind of like a what? Like a sideways kind of shallow type.
So the next one will be
Wave
steep.
B, right, was more of a steep, right? Wave C is more of a steep. But notice though, this is why I tell you guys, use wicks when looking at historical data. And when it comes to the current, go off the closes in relationship to those wicks. Because again, even though this candle closed below these, the bodies of those right there, this wick is the actual low that it has to be broken or closed beneath in order for it to continue down short. So you've got this low and a higher low, right? So we should expect, again, for this to go up. Now, since we're already expecting it to do this type of number on the higher time frame, 15-minute is just going to tell us it's going to do that type of number on a even a lower time frame, right? So what we have to see now is wait for this bearish momentum to die down. Again, we enter in off of what type of candles, guys? Engulfing and Maribozus, right? If I don't see an engulfing or a Maribozu to go long, I'm not going to take the trade. Now, price is already within the entry zone as far as currently, right? Pivoting from that low to this high. Price is, well, almost. It pinned in between the 618 and the 886 already with this candle right here. So depending on what these candles are doing on a lower time frame, I'll go to the 5-minute. Before I do that though, I want to delineate the most recent break of structure from this trend right here. And the structure that was broken over here, I'm going to go off of this high right here.
I wouldn't even look at that as a structure.
Why not?
I don't know.
Look on the wicks coming down and stopping there.
Yep. So the reason why I went off of that, guys, is because again, I look for candles that broke structure. I look at the wicks and then I look at price action. If you all look at this candle right here, hold on. If you all look at this candle right here, right? It's got no wick towards the top of it. Whenever you guys see a candle like that, that's because that candle basically opened virtually on some type of structure, some type of support or resistance, okay? So not only that, I look to the left. Where did this candle pin to? Where did this candle pin to? Where did this candle pin to? Cool. So since I've seen that, I want to delineate that. Now, over here, you find 3 candle breaks of structure. First candle broke it, second candle, third candle, right? 3 candle break of structure. Coincidentally, where did this pin to? Where did this pin?
Yeah.
Right? That's all price action, guys. That's not an indicator. That's just understanding the candles themselves and price action. So
You can also,
right. No, go ahead.
you can also look at it as, you see how whenever he drew the line on the structure on the top, basically that first red candle, all those other candles are staying within that red candle, and what basically shows that it broke it. You know what I mean? Like it basically
Right.
it's all within there, and it broke on top of it.
Right. So again, so that's a good thing you pointed that out too, though. So if this hammer right here was actually filled in with a full body, that would be considered a mother bar. And all of these candles would be inside bars. This would be considered an inside bar setup. And that's another thing that I look for.
It's the same thing as a master candle, right?
So, yeah.
Okay.
So again, guys, you can continue to mark up these charts and stuff like that. Like it. No, I don't want to go from over there. I'll go from over here though. I mean, like, look at this, right? I'm not making none of this shit up. It's not no indicator. This is just all price action. So again, we got this trend line. 3 candle breakup structure. Here's the first, here's the second. So unless this candle takes off, guys, I can't enter in that, right? It's currently going to paint for another 9 minutes. Now, here's what I can say I can do. I can highlight these 2 candles right here and go down to even the lower time frame just to see if there was an engulfing candle or a proper, or a proper 3 candle breakup structure.
There's 3 in a row, 3 green in a row.
There's one. Well, where you at? Right here?
Well, those 3 big green candles, yeah.
Yeah. So looking at this slanted trend line, right? First candle right here, second candle, third candle. That's a nice breaking structure. All it's doing right now is just a retrace from this low.
Remember, guys, 2 of them have to be in the trend direction.
But that's what I was talking about, the 3 big candles from the bottom. Yeah.
Yeah, right here. 1, 2.
Mm-hmm. Yes.
Yes.
Hey,
ma'am.
man.
What's
Does that
up?
have to do with your institutional blocks? I
A
knew
little
it.
bit. A little bit. A little bit. We'll get into that in the intermediate stuff, man.
Yeah, that's in the whole next class.
Yeah, bro. That's I don't want to confuse you guys just yet.
I feel that. I feel that.
Well, you did say something bad. I don't know what you're talking about.
So, but check it out though. So this is the first candle that broke down beneath this candle, this slanted structure right here, right? Let's see what happens with this. Let's see what happens with the close of this candle here at 10. Honestly, if it doesn't do like another, I guess, clean breakup structure, then I know, hey, it's pretty valid. But one thing I do not see yet, guys, is an engulfing candle. But these 2 candles right here, notice how this candle has no wick at the bottom, and then this candle actually wicked towards the bottom, right? That's letting me know something as far as price action, and it's bouncing off of that.
And it's weird because it wicked below that blue can. Yeah.
Yeah, it will do that, and that's why I tell you guys, when it comes to historical data, use the wick. When it comes to current, go off of how those candles are closing related to those wicks. So the wicks are important, man. They're important, believe it or not. Let's see. I can go down to the 1 minute, see what happens. There's an engulfing on my 1 minute. 3 candle breaker structure right here. Retest to it. Let's look at right here. Right here is not really a clear breaker structure, a clean breaker structure, I should say. This is better, but again, not necessarily clean. So we could see it come back down and retest this line one more time. Maybe, just maybe. But again, that's the 1 minute chart. It doesn't really matter too much. I'm ready to see what's going to happen on this 15 and 5. And guys, this is pretty much everything all in the jam. The only thing I didn't draw up on here for you guys is the complete Elliott wave. That's it.
Enjoy.
But I did, like I said, I did identify what I could see clearly. So here's the thing, guys. When it comes to Elliott wave and trying to identify it, the first thing, guys, that I'm looking for is the guideline of alternation. Because again, that's only dealing with 2 waves, right? And since we're entering off of retracement, hell, that's what I want to be able to identify first is the retracement. And since there's only 2 retracement waves, you should be able to identify that. Let me zoom out a little bit, and I'll show you guys some things while we're waiting for this current 5-minute candle to pretty much happen, right? This right here, guys, is a whole mess, okay? Not even I can really see Elliott wave, but just know that this right here is a whole mess right here, right? Yeah, there's no really counting or looking for Elliott wave in this instinct, in this jumble right here. just because it's more of price is within a range or a consolidation than it is actually trending. Like something like this, right? Even in this mess right here. So if I was to count Elliott Wave or look at Elliott Wave from on that pattern, it'd be something like this. Before the retracement happened, right? But now notice on this A, well, you can do A, B, C. What happened though? On this ABC right here, what happened?
It didn't break structure.
No,
No, it did. Actually, shot up.
it did break structure.
It did break structure. It did break
Correct.
structure.
So going back to the Elliott Wave training, I said that this correction can't close above or below the high of wave 4, right? It sure hell did. It came right back and tested that motherfucker. Excuse my language, and then it kept going. That's how you delineate a change in trend direction. If this correction breaks the higher low, depending on what kind of prior trend you're in or you were in, that's how you delineate a trend change. That C push broke that structure right here. Let me see if I can find a better, clearer one for you guys. Because again, guys, understand that, you know, the Elliott Wave picture that I showed you guys, that's perfect. It's not going to be perfect on these charts.
Right.
Yeah, because that first leg and that third leg wasn't the same length, but I get it though.
Mm-hmm. Let me see. Let me see.
How soon do you post this to your YouTube after you're done with it?
As soon as possible.
So I have to once we end it, we have to wait for it to render to the cloud on Zoom.
Right.
And then I have to get the link, share the link to him because it is so long. I can't download it and send it to him. I have to send him a share link, and then he has to download it to his computer and then upload it. So, I mean, usually by the next day for sure, right, Wallace? I don't know if it'll happen tonight, but usually by the next day we try to have it uploaded.
Because the last class I've now watched like 3 times. And it was like 4 hours, bro.
That's good. The last class was fire.
It was a little babble in the end, though.
Right, but I'm here to win, so.
I hear you,
That's
Trey.
it.
I've watched it twice already.
There we go. So check
There
it
ain't no losing. DX don't have losies. We don't lose.
Nope.
Losing trades, yes, but
This is a 3 candle reversal pattern.
That's anywhere.
Right here. This candle, this candle, this candle. So since that is happening, guys, I'm still paying attention to where this is closing. Now, here's what needs to happen in order for that to still be a valid buy. This next 15-minute candle after this one closes, unless this one pulls back and closes above this pink line, it most definitely has to be bullish with some type of momentum. If not, it's going to be continuation short.
Okay.
But that's just from reading price action. What is that? Oh, okay. What the hell did I do? Huh. Appreciate that Wendy's split.
So you're saying the next candle has to close above the previous, above that doji,
Yes.
or above that whole little structure there?
Yeah, definitely above this pink line, this slanted pink
Oh,
line.
yeah, yeah.
And
And above that
right,
last candle.
yeah,
Yep.
be close above that doji. And that's just price action itself, guys. You know,
hmm
that's all that is. Let's see. Let me do something real quick. While EQ is playing out right here, I want to look at, well, damn, look at this though. You guys pulling back already?
Yep.
That's why.
Love the trend lines.
Oh yeah, crucial to wait for the candle to close. Let me see. All right, so I want to show you guys this on the triple grid real quick. Hour 15 and the 5.
Price action is everything.
It really is.
Yeah.
It really is.
I mean, what Wallace said earlier, it really is the truth. I mean, like, you know, a lot of people like to pay attention to those EMAs, and they're great for
an extra.
an extra on top of the 3, you know.
Odds enhancer. Yeah.
But price action, the candles are, I mean, like I say on my newbie thing, it literally is a language, and we teach you how to read that language.
Mm-hmm. So check it out, guys. This is the triple screen, okay? You get 3 different views of the same setup, right? So over here to the far right, we've got our structure chart. To the middle, you've got your entry setup chart. And then to the left, you've got your candlestick entry. So here's how it actually works. This is amazing that it's playing out like this. So going back to Elliott Wave, we have identified this as A, B, kind of C type of movement that we're waiting on, right? Going back to Elliott Wave, the guideline of alternation between wave A and B. Wave A is more of a type of steep, aggressive type of move. So wave B is going to be the zigzag, right? Now wave C should be that extended type of move out. And
it should be the firmest or the motivated move.
Exactly. So we got that on our structure chart, right? Now on our entry setup time frame, what we did, we stood from this low to this high. We've seen price was in between the 618 and 886. Actually, this red candle pins in our entry zone and closed above it at our 886. Now we're reading, since it's at our entry setup zone, that's all we want on that time frame. Okay. Entry setup, draw your charts, your drawing tools up, see what you can see. Go to your candlestick entry chart. Your candlestick entry, guys, what do we want to see? An engulfing fucking candle, guys. Not only that, this engulfing candle broke this structure. So what we can do is wait for this candle to play out, and then the next candle to play out to give you that 3 type of candle break the structure of this planet trend line, and that's your entry. Little to no drawdown because you're on the 5-minute chart.
Yep.
You see how it all plays out now?
Yep, this is awesome.
Yep.
There you go.
This is so clear.
Total fucking sense.
I love it. I love it. This is so awesome.
Torrance, this is that graph that you saw in the very beginning, the green within, or the black within the inception, basically.
Right.
The inception.
Yeah, so explain it now.
Let me go back to the keynote for you real quick. Let me go back to it, right?
Yeah, go back to it. There you go. Bam. That's what we just looked at in those 3 charts.
Okay, now explain how you...
All we did was align each of the Elliott Wave sections on 3 different charts.
Okay. So the black is the 5-minute.
Right.
The green is the what was it, 15?
15, and
the blue is the 1 hour chart that he was just on.
Okay, so instead of 1, 4, and daily, it's just swapped.
Don't pay attention to this stuff right here.
Okay.
I'm trying to real time. This
5, 15, 1.
Right.
It doesn't really matter. It doesn't really matter the exact ones. because you're always going to look for, as Corey said earlier, you're always going to look for the best one for your support. It could be the 4 hour, it could be the daily, and then you're going to work your way down, and then you're going to find the next one for your what is it, the entries
for
entry
entry
zone?
and stuff.
Yes. So it's not always going to be it's not always going to be the daily, the 4 hour, and the one. It's not always going to be that. It's going to be the best one that you visually see.
Exactly.
Right. It all depends on like how we trade.
Yeah,
Right.
it's just whatever looks the cleanest, whichever time frame looks the cleanest for your support. Wherever you find it on the cleanest chart, that's the chart that's going to be your support one.
That makes
but
sense.
You're always going to have 3 charts. Okay, and the highest time frame is going to be, what was it? The blue on the slide.
So the highest time frame is the structure, is the trend, the structure.
Correct.
The trend, yeah.
Okay.
Yep.
And you already went over how to set up these 3 screens, right?
So, yeah, a little bit, but I'll touch on that again. So these 3 screens, these 3
Hey now.
Squeens.
Damn, you drinking too or what?
Shoot, man, after today I need
2.
something, you know? But yeah, these 3 screens, guys, this is part of the paid program of TradingView. So you don't have to necessarily buy it if you don't find this, I guess, beneficial. But you can, like I said, if you do it on one screen, it's beneficial. But if you can do it on one screen, guys, hey, more power to you. I started out with 1 screen. I only bought it just because I wanted to show you guys the full system. But I'm pretty versed in it now, where I don't really need 3 screens. I can just, click in between them, right? But starting out, it's kind of recommended that you guys use the 3 screens because of what I just showed you.
Okay, so can you show me Elliott Wave on them 3 screens right there?
Yeah, let me see if I can actually, because again, I didn't see it real clear on the 1 hour.
You didn't see it real clear on the 1 hour?
No, because so even if I look from this low to this high, all of this is just kind of like just a range or consolidation. So it's not real clear to even me personally, right? So that's, sometimes it's like that. Like I said, it's like that. It's fine and dandy. But let me see here.
It looks like it's just nothing but consolidation and breakouts.
Exactly.
Yeah. Nothing is always going to happen all the time in Forex or any market.
Yep. No always, no.
Yeah.
But what I can say though is, even in identifying the ABC correction, hey, we are able to correctly identify this portion of it, right? With wave A being kind of like the aggressive, steep type of thing, wave B being a zigzag. Now wave C should be some type of nice momentum coming to it. And that wave C should go back into our structure in our void area to continue the trend from the daily chart. And that should be down. So what I would say is, it may trend up. C might be the London move for tonight, right? And then come New York or halfway into New York session tomorrow, it may reverse on us for midweek reversal.
Midweek reversal. Gotta love those, man.
Oh man, that's gonna be dope. But yeah, man. So I can't show you the full Elliott Wave on this one, Torrance, man. It's not clear for me, if that makes sense.
Yeah, I'll be having a hard time identifying on the charts.
Yeah, and you're gonna have that starting out at first, guys. And like I said, it's normal, it's natural. But what I would recommend is pick out a guideline or 2 to focus on. My first and favorite guideline was the guideline of alternation, since we want to then enter on retracements anyways. It's just gotta be able to identify them, right? So, but yeah, man, this is all it is. It's nothing.
Come on, man. This ain't all it is. There's so much more to it.
There's
but
so much just to this.
Yes.
But no, it's not rocket science, guys. I think that's what he was really trying to get through to you.
Like
Here comes that 5-minute candle too.
Right. Exactly.
Right.
So, but check it out though. So like I said, this first course that I'm going over with you guys is just the foundations. Look at this shit. And it's enough to pretty much like get you guys making some type of profit and understanding and learning on the right path, basically, right? And then intermediate and advanced class, that shit's gonna blow y'all out the park.
That move is happening.
Hey, what do I gotta pay for that, or is it under DX?
That's gonna
Because
be
I'll pay for it.
that's gonna be under. Don't worry about it, brother. That's gonna be under DX and the exchange, so you're good.
Yeah.
All right, I'm just saying it's worth it to me.
Y'all got to throw your X's up, though.
Clearly, like look at this. Look, like I just showed
I
you guys how
stay throwing them up.
right in real time, right? And look at it. So like, I can't.
Oh, look at that candle.
I can't make this up.
I've been trying to tell you.
Oh, I've been in this. I got in.
Yeah. So if you did get in though, guys, understand that you're catching a C move, right? So don't collect your 20 to 30 pips if you got in the right spot, and understand that this is just a C move as a part of a retracement. Okay.
Yeah.
Right.
So, but yeah, man.
It is a counter trend
trade.
Yep.
It's an advanced entry trade.
Right. So get in and get out.
Yeah.
No marriage.
Trade.
Yeah.
But
But
hey,
that's all we need is 20, dude. At least 20.
just think about it. So here's the thing, guys. If you guys just focus on catching a consistent setup, whether it's 20 or 30 pips, you'll be fucking straight. Because that's going to compound and grow so quick over time. I don't really think I realize it. Like that shit's strong.
Yeah, I need that 60K bag you had a month or so ago, man.
You'll get that soon, bro. Straight up.
Yeah, I ain't forgot.
Yeah.
So, are there any questions, guys? Let me check this chat real quick.
I've been kind of watching it.
Have you? Cool.
Yeah.
I got a question.
Yes, sir.
What's a pip, man?
Now,
You got to come to you got to come to my webinar for that.
Oh man, I'll be there, man. I'll be there.
My webinar teaches all that shit.
Oh man. So I'm glad that setup was out there, bro. Whoever told me to look at EU, I appreciate you.
You are welcome.
You're
Thank
welcome,
you for
man.
doing that. I appreciate it.
Because I mean that thing's about to pay you out pretty nice.
Corey.
So, but yeah, man.
Hey, Corey.
What's up?
Will this recording be posted somewhere?
Yes, sir. I'm actually when we get
On
done,
Facebook.
start rendering it, and then I'll post it on my YouTube and I'll email a link to everybody.
Will we be posting this on Facebook also?
Yeah.
I'll
In
paste
DXU?
the link in DXU.
Yeah.
Yeah. So Debbie, we just don't want the reason it's closed.
Yeah, I got it.
The reason it's closed is just because he doesn't want people coming in halfway.
Right.
through.
No, I knew. I thought I didn't know if we were going to do this in the paid members, the new DX.
Oh yeah. Well, I mean that's up to Wallace.
Can we do it under a different unit though? Like a unit specified just for that?
Oh yeah. I mean, if do you want to?
We
do
would
that,
just call
Wallace?
it Ward
Do you wanna
3 or
post them?
Wallace.
Do you want to
Wallace.
post them in the thing?
Yeah, just call them Sherpa.
Okay, so then I'll create a unit right now. I'll create a unit right now, and we'll call it Sherpa Strategy.
Right. So here's the
Sherpa
thing.
Strategy with Professor Wallace.
Right.
Indeed.
I like it.
So understand that the biggest move that we want to catch is a down move. So I'm gonna set my pending order in between the 618 and the 886, right here where this yellow line is somewhere, probably at the void.
Somewhere around 1775, which is a quarters level.
Bingo.
Bingo.
Set my pending sell limit. Set my my fucking stop loss and my take profit. Go to sleep.
Nice.
That's all it is, guys. Like
That's beast mode.
I'm not gonna say that's all it is, but yo, that's really what I just showed you guys. The move that just happened live, like that's all it is. Repeat, right?
We live, baby.
We ain't going to sleep tonight, baby. We up all night.
So, but that's all I got for you guys tonight. Next class is what's today? Tuesday?
That
next
was
class-
great. Tonight was awesome.
So listen, guys. Next class is supposed to be Thursday. Okay. I think I may have to reschedule that because I'll be dropping back home, and then I leave Friday morning at about 4:30, 5 o'clock for North Carolina. So yeah, a lot of
Yeah,
travel.
so as you guys don't know, Wallace is not even home right now. He
Right.
is
He told us. This is
Okay.
awesome, Wallace. And Corey, thank you
We
for all you
appreciate
do.
you, man. With
We
all our
really
heart.
appreciate you.
Very welcome.
For real, man.
Make it at your convenience. We'll be there.
No doubt. So, oh well, hey, I'm just letting you know I'm going to a wedding in North Carolina, so I won't be available at all this weekend, guys. So our next class probably won't be until Tuesday.
Well, we're looking forward to your wedding as well, man.
Wow.
Give us time to rewatch this another 5 times.
All right. Let me see.
But don't forget, guys, we do have